Good evening, everybody. Whichever part of the world you're from, you would like to know what's happening with investments, right? And today's webinar is about the future of investments into India. This is Vishal Krishna, your business editor from Your Story. I've got me an esteemed panel that can talk on these points that can help you understand what's happening in the Indian market. We're going to interpret press note 3, which is the most happening press note to understand what's going to happen from investors from abroad if they're coming into this country. The panelists will interpret the press note. There's going to be due diligence by foreign investors that will be explained. Special carve-outs for Indian investments too will be spoken about. Let me introduce my panelists. I've got Jitesh Kumar, the managing partner at Stubb Kasiva. I've got Vinod Menon, who is the general counsel at Axel Partners. I've got Ted Craig from the UK. He's a partner at Denton's London. I've got Anirudh Ashok Damani, who's the managing partner at Artha Venture Fund. And I've got Abhinav Sinha, who's the director at the CDC Group. Welcome to the webinar, guys. How are you? Is everybody fine? Everybody doing well during the lockdown? All well? Right? I'm going to straight dig into the questions immediately because it's such a pressing issue. Vinod, maybe we could start with you. What's Press Note 3 all about, or the Press Note all about, and why is it being announced at this point of time?
Sure, Vishal. So first, let me thank you for that introduction, Vishal. And I would start with that Press Note 3. First, I would like to set up that context. Then thereafter, that we can have a very detailed discussion on this Press Note 3 with that panelist. All of us are aware of that. As per that prevailing laws, all the foreign, any non-resident entities can make investments into India subject to that FDI policy, except in the case of that sectors which are prohibited for that foreign investment. However, in the cases of Bangladesh and Pakistan, there are certain restrictions. In the case of the Bangladesh and Pakistan, they can make investments into India only subject to that government's approval. Further, in the case of the Pakistan, there are some more restrictions. They can make investments into certain sectors such as defense, space, atomic energy. They cannot make any investments into those sectors, which is completely prohibited as far as that Pakistan is concerned. Now, when it comes to the Press Note 3, which is a very significant move that recently that government of India through DPIA, IIT made that. They extended these restrictions to all the countries which are still bordering that land with that India. That means these specified countries, these neighboring countries, cannot make investments into that India or any entities which are settled in these neighboring countries or any beneficial owners from these countries or any of the citizens of these countries cannot make investments into India without taking that government approval. Please note, this is not a prohibition. This is only an approval route. But in the case of the Pakistan, it continues to have that same restrictions, which they have to, they cannot make that investments into the sectors which are already prohibited. Why actually that, that reason for that doing this, that Press Note? The reason is that, that curbing that opportunistic takeover during these COVID scenarios, and which has been following that to most of the countries, not just India, that probably would have seen that in many countries have followed this practice in the past or during this recent time. And incidentally, that we could also see that Chinese central bank acquired that 1% stake in the HDFC, and this it was a coincidence that immediately after that, that governments of India's notification also that came into force the very next day. With that, I would love that, Vishal, that to start with the more discussions on this topic. Especially, there are a lot of interpretational issues and procedural issues relating to this Press Note that our panelists can discuss more actually, because that there is a lot of confusion in that investors community that what does it mean by the beneficial ownership, which is all talking a lot about in this Press Note, and there is no clarifications or interpretational issues on that. So let us more get into that detailed discussions. Over to you, Vishal, now.
Okay, I'd certainly love the panelists to discuss more about why the neighboring countries, and maybe we could talk about it in the end of the session. I want to move on to Jitesh. Jitesh, there's something called beneficial owner under this Press Note, which I've read too. Who is this beneficial owner, and who is this addressed on?
Firstly, thank you, Vishal, and for this, and thank you, Vinod, for the wonderful introduction. Good morning to friends from the US. Good afternoon, friends from UK, and good evening to all friends from India. Um, while all investments from countries with land border to India are subjected to this press note, interesting to note is also the situation of Hong Kong, Macau, and Taiwan. I'd like to address this before I head into interpreting and defining the beneficial owner. So talking about Taiwan, India has extensive commercial relationship with Taiwan. However, it doesn't recognize Taiwan politically and does not have any diplomatic ties with Taiwan. So if you really look at it from the strict interpretation of law, it means that all investments from Taiwan will also be deemed as investments from China, and hence it may require government approval. However, it is advised to investors from Taiwan to seek some formal guidance, at least from the government, to identify if they're required to obtain any government approval for the sake of this particular press note. Now, coming to Hong Kong, India has recognized the transfer of sovereignty of Hong Kong from UK to China way back in 1997. So while Hong Kong enjoys the one country, two systems policy, this press note is applicable to countries and not systems. So hence, in spite of China allowing it to operate under a separate system, it will still be considered as part of China. This means that all investments from Hong Kong will also be governed under the press note. The same rule applies also to investments from Macau. There's also a strong possibility that most of the entities investing into India, either from UK, USA, Singapore, Netherlands, or other tax-efficient jurisdictions like Mauritius, Cayman Islands, etc., may have a Chinese investor or shareholder. This Chinese investor could be holding complete or maybe majority or minority or sometimes even inconsequentially small number of shares in these entities. The press note or the NDA rules does not state whether this term beneficial owner means only the immediate investor or its holding company or the ultimate beneficiary. There is definite lack of clarity regarding whether we need to look at only a few layers of the holding company or the entire genus of the investment. If this were so, it would really be a practical nightmare for lawyers and investors. So all investors, even with one Chinese investor holding one share, will now need the government approval. The big challenge now is that each investment into India will now have to pass through a microscope to determine who is the beneficial owner. Let me also now provide you some guidance on the term beneficial owner as existing under various rules as well as laws in India. I would go from the most liberal to probably the strictest. The most liberal one is under the Prevention of Money Laundering Act. The laundering rules, the Prevention of Money Laundering rules describe a dual test based on, firstly, economic participation and secondly, control to identify the beneficial owner. So this puts the threshold at about 51% for being identified as a beneficial owner. The principles laid down in the RBI, the second one would probably be under the RBI. So RBI has issued Know Your Customer directions in the year 2016. And this was used or is currently also being used by the banks to evaluate their customers. So this lays down a threshold of about 25% of on the investors or shareholders of companies to be called as beneficial owners. The third one, or the stricter one, is as per the Companies Act. Interestingly, the Companies Act and its rules uses the words beneficial interest and significant beneficial ownership. However, the term beneficial interest we have seen is limited to shares, and it can be interpreted to not include situations of other equity instruments. So now, under the significant beneficial ownership rules, any individual who alone or with a group of other individuals or in trust exercises or holds 10% shares or 10% voting rights or retain a right to receive about 10% or more dividend, either directly or indirectly, can be called as a beneficial or significantly beneficial owner. Now, due to the
Jitesh, do you want to continue in the end? I think we're running short of time because each panelist has probably 3 to 4 minutes. Do you want to pick that up later on? Right.
Absolutely.
Let's move on to the
Absolutely.
next question because I want to go to Abhinav and talk about him being part of a foreign fund. What are the challenges that you see coming from the press note, Abhinav? And is it going to affect every investor's outcome in this country? Thinking about, okay, there's anyway so many regulations here in India, and now, as Jitesh mentioned, it's going to be a microscopic view on things, and you have to prove everything. Is it going to be difficult for you guys to come in and invest, and also have family offices from abroad participate with you guys?
Right. No, Vishal, thank you. And hello to all my co-panelists and everybody else who is listening to the webinar. Look, I think these are extraordinary times for investors. What's happened is, the press note is a reaction to COVID-19, and there has been a significant business effect on either the portfolio or the new investments that investors like us are looking at. So either some businesses have been structurally impaired. So I'm talking about hospitality or businesses which are into some sorts of lending and so on. There are a few businesses which have benefited from this. So whether it's telecom delivery or online wellness or education. Now, as investors, we are really trying to think of our portfolio very carefully and saying, well, which bucket does this fall into? If they are structurally impaired, we will need to raise extra funds, right? And in short order. And here, if your co-investor happens to be either from China or has an LP which is from China, it creates quite a bit of concern, right? So if you look at the Indian ecosystem, I would say there are really three sources. We've got the Western sources, the likes of Sequoias and Accels, and that's going on fine. You've got the local funds, so Artha is one of them, Pravegas and Stellarises. Many of them might not have LPs who come from China, but the jury is out, and we don't really know statistically what proportion is getting impacted. But there is a big and vibrant section from China, and this affects larger firms like your Paytms, which have the Alibabas and Tencents, but also a very large chunk of the smallest firms. And so, as an investor, it really worries me that in these difficult times, we may not have all of our co-investors being able to fund the companies. It's also important to understand that right now it is impossible to do diligence on a new company because of we are all remote. You cannot really initiate a process. So this does run the risk of bringing that investment into this ecosystem to a halt. Something we have to be careful about. And finally, I would make one point. Look, as investors, it's great to get clarity. So I think Jitesh was mentioning that it's not easy to interpret what beneficial ownership is. I think everybody appreciates the rationale behind this press note, which is to protect systemically important companies. But I think the more clarity we have, the easier it is for us investors to then proceed. So I'll pause here, Vishal, and maybe take more questions.
I mean, I'm glad you said you look for clarity, and I wish the government's listening in and they give you clarity soon. And it is so strange. I know Anirudh for a very long time, and we've met dozens of his startups, as your story. Anirudh, do you think there's a black mark upon the Indian funding ecosystem? What challenges do you see? Do you think it was the right time to announce this press note also?
I think so. See, China was the first one to get into this pandemic, right? They were affected first, and they've also come out of it faster than everybody else. Their economic impact hasn't been as deep as something like India or maybe even in the Western markets. So obviously, there's an expectation that they would have, their investors and their companies would have more cash and more money to invest today than everybody else that is still dealing with the impact of this pandemic, right? So obviously, and then because the prices have fallen in India, it's looking at stock markets. There are stocks that are down 80%, 90% in some cases. So, there is going to be some aggressive acquisition interest from Chinese investors. So in that sense, I do understand the government's need to protect Indian companies and our IP, so that we don't at this point lose out, years of value building in, a 6 to 7 month period, right? And I can definitely see why they have to do that. But, it poses three questions, in trying to save, maybe someone, are you like burning down the entire farm, right? So now the question is, who's going to fill in the void, right? Chinese investors pumped in $4 billion over the last 24 months. Right? If I look at Alibaba, Tencent, Shunwei, SteadView, Fosun, and Hillhouse, they have 90 investments in India, and Chinese investors have 60%. I mean, there's a Chinese investor in 60% of Indian unicorns, right? We can't forget that. And like Abhinav was saying, this is the time some of these guys need money. And now suddenly, if you realize that your investor has directly or indirectly got a Chinese investor, and I don't really know what I know Jidesh was explaining it for about 5-6 minutes, but I was still confused. Does it mean that if somebody has one shareholder and they're still considered to be Chinese beneficial interest, or if they have a holding company that has one investor, does that count? Like, how deep does the rabbit hole go, right? So in that sense, as a fund manager, and we've got, even though we're a micro VC fund, we've got a bunch of institutions, family offices. We've got about 12 listed companies, which again have changing ownership every single day, right? And to me, it occurs that how do I know exactly whether I'm in compliance at this point or not, right? Or how do I know that tomorrow, if I have, the government of India fund of funds has been quite slow in disbursing capital. I mean, if you look at the 10,000 crore fund announced 5 years ago, I don't even think they're at 50% today, right? And this is when we had the best bull run in the PVC industry over the last 5 years. Even then, they could not deploy all the capital. So who's going to fill in the gap, right? And the second question that leads into it is that, we've got drawdowns awaited from, again, these family offices, these listed companies, these, institutions, and some of them I know would have Chinese beneficial interest, if not directly, then indirectly. Can we go ahead and ask them for the next drawdown? What is the kind of timeline is going to take for us to receive that drawdown? And would some of these investors, would they be open to actually revealing all their books? Because sometimes, and I've met Chinese family offices that are based out of the US or Canada, or a tax jurisdiction that works best in their favor. They're based out of there, but their actual beneficial ownership could be or wealth created in China. What happens in that case? And again, are they open to revealing all the cross holdings that it took to get money into Canada or into New York or into San Francisco? And it just already muddies what was already not very water, right? I mean, we had a Greek family office. It took us 6 months to get a drawdown from them, right? We signed the paperwork in September. We just got the money credited to a bank account. And now imagine if that had a Chinese beneficial interest. If it takes forever, these investors are going to run, right? And I think that poses more questions, because if as of now, nothing that the government has announced actually provides any kind of direct help to startups. I think we're getting clubbed into MSMEs, and that's not really helpful, right? And again, we don't really have any aggressive interest from fund of funds saying, here, the Chinese money isn't coming, let us give you $1 billion to all these funds, and you guys make sure that the startup market doesn't collapse. It hasn't happened. And so that lacuna is still there. And the third question, I think Abhinav also touched upon it, and I think they know that, and Jidesh talked about it, is that what if you're still fundraising, right? And if you're asked that question, how am I supposed to answer it, right? Is it 10%? Is it 51%? Is it the holding company? Is it the holding company's holding company? And that creates more problems, right? But let me also not completely just talk about the gloom. I think there is a good opportunity for early stage VC funds like Pravega, like ourselves, that you could see a situation where Chinese investors who are coming in directly into these early stage companies may prefer coming through a fund now, because it may not be capital efficient for them, right, to directly write a 2 to 5 or 10 crore kind of check. Right? It may be better for them to come through a fund format where they've done a drawdown. They probably own, put in a larger chunk over there, and let them deal with the individual investments that are happening, and then really focus more on when they're writing the $50 and $100 million checks, where it's, where the expenses of getting all of this done justify the investment that you're making. So there could still be some a silver lining to all of this, but I think there's more questions than answers at this point.
Okay, Anirudh, that's superb. You've actually set the context, right? Now it's like nationalism is sprung all over the place over the last few years, and this COVID even makes it even worse. Ted, I think you should tell us. I think, will there be India-specific vehicles going forward now for investors? Will they have to set up specific vehicles in India? I mean, I as a journalist love to compare, right? I mean, they're pushing for data sovereignty to have data within India. Now they're going to say, investment arms should be registered in India. Is that going to happen, Ted? What do you think?
Yeah, I think it's such a complicated situation. I think it's interesting that some of the conversations I've had around this and similar restrictions that are put in place, initial reaction from some people actually is to build in the equivalent of an excuse right or an opt-out right for investors, so that if you have Chinese investors, and I know there's a question mark here as to what we're actually talking about, but effectively, that beneficial owner that is Chinese effectively have an excuse right. That means where there's a capital call for an investment that would go into India, capital wouldn't be called from that particular investor or group of investors, and obviously they wouldn't benefit from distributions from it as well. And that's a fairly well-trodden path within fund structuring and fund documentation. The challenge here is obviously this is about ownership rather than just financials. So it's not just about excuse rights were typically put in place actually at an LP's request for sort of policy decisions, say, where they didn't want to be exposed to particular types of investments in certain industries and things. Obviously here we're talking about a specific restriction, and so sort of deviating cash flows away from a particular investor doesn't work. It's about ownership. So I think the only sort of practical, and I use actually that term in slightly inverted commas because the practicalities that we've already talked about on this call aren't necessarily there, but the only practical solution is to have parallel vehicles within the fund. And I think it'll have to be a sort of fund by fund question as to whether what we're talking about is putting the Chinese or Chinese related investors into a separate vehicle, or specifically Indian investments into a separate vehicle. But effectively what you're doing by setting up parallel vehicles is separating the Chinese source money from the Indian investments, so that you're not tripped up by this restriction, which is it's a fairly I suppose I could say neat solution. The challenge though, because I think we really need to think about two camps here, is actually people who are currently managing a fund and those investors who are fundraising and structuring a new fund, because actually putting in alternative investment vehicles, parallel vehicles into an existing fund is certainly doable, and a lot of fund documents contemplate it. And I suppose I'd advise anyone who's encountering this problem to look at their fund documents to make sure they can do this. So they're often allowed to do it, but actually doing it practically is another thing. And as we talked about, if you're about to call capital from investors and suddenly this restriction applies, how do you deal with that in a live situation? Because effectively you're having to sort of move investors around and or move assets around. It's slightly simpler if you're currently structuring your fund, in as much as you can contemplate needing parallel vehicles. And again, lots of funds approach, for various legal, tax and regulatory reasons, will go to the market with the possibility of parallel vehicles to accommodate certain restrictions and things. So you could certainly see people coming to the market and basically saying, because we have an investment strategy that will invest in India, we've managed our affairs such that we know if there's Chinese money, it's going to be put into a vehicle that isn't commingled with other capital. The big question here, though, these are sort of the things that you can do, but the overarching question, it seems to me, on this panel is that question around what a beneficial owner is, and are we talking about a single dollar coming from China, or is there a much higher threshold that needs to be met for this restriction to apply?
Great answer, Ted. Great answer. I mean, it sets the context to, Vinod, if I have investors as a startup, I'd be worried because I have to go convince them to look at various laws, and I'd be running around. And as a founder, I'd be worried. So how do you comfort these investors and LPs? Who comforts each other? Who plays the role of the psychiatrist at this point of time?
interesting question, Vishal. I'm glad that you asked me this. So, but unfortunately, there is less clarity on this. So, we are all looking forward to have that, more clarifications from the governments on that, or expecting an FAQ. But having said that, if you could look at it in the case of that FIPB or that DPIIT, whenever they give permissions to that Indian companies, so once they give the permissions that you don't have to go back to them any further fundraise from these investors as long as you don't breach that threshold, percentage of the threshold, which has already been approved by the government. But unfortunately, in the current press notes and in the case of that RBI, that notifications, it is not, there is no grandfathering clause attached to that. So because of the lack of that grandfathering clause, now that we are all trying to figure out how this, that our startups and the companies can, whether they can raise money more from that existing investors or whether beneficial or anyway, that of course that we discussed in detail. But in relation to that existing that fundraise, that we don't know actually whether we need to go back or not. That is the one aspect. And second aspect of that, bonus issues. The companies goes for a bonus issues very often that if I issue a bonus issue, do I need to go back? Or because there is no change in the shareholding pattern, right? So that is we need to have more clarity on that. Similarly, in the case of that, warrants, that some of that, that investors from these specified countries that bought warrants in that many Indian companies, which the companies have a contractual obligation. All our companies have a contractual obligations to allot them the shares. But now the companies are stuck. Now they are asking us like, what should we do now? Actually, should we go back to the government or that get an approval? So there is a lack of we are expecting a grandfathering provisions in this, or because of lack of clarity in this notification. And there are also a lot of that we have that shareholders agreement with that the specified investors from this, investors from the specified countries, basically talking about they have the put option right, they have the drag option right, they have the call option right. We do not know now, as of now, whether all these contractual obligations can be fulfilled or not, which is the one like we are looking forward to the government and see that uh, whether government would issue the more clarity on all these aspects. Otherwise, it would get into various interpretational issues and it would create a lot of confusion in that the companies and the corporate setup.
Vinod, you have to tell me, we had problems like with angel tax a couple of years ago. It's not going to be the same thing, right? Tell me, because I am a senior leader in this company and I don't want to be running around again answering a lot of notices. Quickly, tell me that.
No, this is actually that something different, Vishal. So this cannot be treated like that, that angel tax. Angel tax, we had some clarity from the departments that, but it was more, it was not a clarification issues. In this case, issue is more an interpretation issues that. So we need to have a more clarity and procedural steps how to deal with this.
Okay, at least that makes it easier because Abhinav, now you can actually invest in our country, right? You can think about coming in easy without having to worry about running around with a lot of notices. So tell us, what will you be looking at while coming into this country in the future? How will investments pan out in India?
Look, I think at some level, whenever these sorts of continuity happen in the market, you can expect a flight to quality, right? So you will see a lot of investments move to founders who are proven or companies which are doing well, and there'll be a bit of polarization. So I think we will face or see a phase where investments will trend to move to more quality companies, or what is perceived as quality. Two, for sure, there will be a bit of discipline on pricing. And we know the Chinese investors will struggle for a little bit. We know SoftBank is more restrained these days, so there would be that discipline. And so, from an investment perspective, from a new company, I mean, those are positives from where I sit. Look, we discussed, I think, the points earlier around the need for clarity, whether it's about grandfathering clauses or really defining beneficial ownership percentages and so on and so forth. And I think as investors, we need to engage with the government. The rationale for this press note is quite clear. And I think there are some unintended consequences that we need to make sure are addressed properly by the government. And look, I think it's also important for us to be clear that these times when we have seen maybe one quarter or maybe even half the year of trading go for most companies, the recovery is not going to be that quick. I think everybody needs to focus on cash, and the government would recognize that a lot of employment is generated by these startups and the VC ecosystem. So we can come to a solution through engagement, and we'll continue to see some investments into quality companies. But if you are on the edge, it's a hesitant time for people. So
That's a
yeah,
good answer too. But that's a positive answer. Thank you for that. I mean, Anirudh, exits. I mean, I love the way you exited Oyo, and that was fantastic. And so you tell us, I mean, are there going to be more exits today? I spoke to a Hyderabad company who's got a great offer from an English company, actually, incidentally. So it's in the card space. I can tell you that much. So you let me know what's going to happen with exits in this country with all this press note coming around suddenly.
I think my concerns are similar to my earlier ones. I think Vinod, Abhinav, they all covered parts of what I'm going to say. In the 24 months before the lockdown started was probably the golden period for PEVC, right? 80% of all exits in PEVCs in the history of Indian PEVC happened in the last 24 months. Now, a lot of these exits were M&As to listed, unlisted companies, as well as some funds and things like that. So again, the question comes up that I can tell you from the 16 exits that I have been part of, including Oyo, right? The key to these exits was speed, right? Because I don't want to be in a situation where we agree to an exit today, and then for 12 months we're still trying to figure out how to get the money into our bank account, and it's happened in the past, right? And because it affects the IRR, right? All of us are looking after IRR at this point. So let's look at two scenarios, and I'm hoping we have amazing lawyers on board, and we can get some advice here. Is that now the person that is giving me an exit is Chinese owned, directly, indirectly. Again, I've already talked about the rabbit hole part. Would that lead to issues at exit, right? And now who's the onus on? Is it the onus on the acquirer or the seller to figure out whether the beneficial ownership of the acquirer is Chinese or not, right? And how long could approvals take, right? I don't know if it's going to take 1 month, 2 months, and then there's a whole issues after that also take place. But the bigger question that I have is, what happens that the at the time of KYC, or at the time of discovery, we figure out that there is a certain holding structure, but then later on, 6 months later, we realize it was something else. Can the government come behind us at that point, right? And that's the problem, right? There's no clarity here that is who's the onus on. And when there's if the onus is on the seller, it could lead for me to ask for more information, more clarity, and all of this could obviously lead to the acquirer feeling as if they're under some sort of a third degree, right? And would that continue to keep them excited about the exit? I'm hoping these are some very critical questions, also basic. I may be really oversimplifying this at this point, but I expect that the government will work with investors, whether they are from India, from China, or the rest of the world, to resolve these issues, because the exit momentum that we had, it needs to restart, right? And I think that was leading to a lot more confidence into Indian VCs, into Indian PEs, and even into Indian startups. I mean, we raised 34 billion in 2019 as the overall investment coming into PEVC, and that momentum has to continue. We need to rebuild it when some of these issues getting answered or resolved is going to be the key.
How many investments between all of us that you're talking about, Abhinav and you? I mean, Anirudh, you must have lots of investments, what, 40, 50 you guys, all of it combined, more than that? You've been talking to entrepreneurs called you about this? Have entrepreneurs called you about this? Are they worried?
So yeah, Abhinav, maybe you want to take it first.
No, definitely. I think there is, for a lot of in our portfolio companies where you've got the Chinese investors sitting, there has been discussion saying, look, how do we think of our next round? There's several, rounds we're trying to do right now. So this is a big issue. It's not a small one. And I think Anirudh raised the point that maybe 60% of all the unicorns in India have an investor sitting there who's from China, right? And I think maybe it's a bit lesser as you go towards the early stage companies, but everybody is considerably worried.
Okay, this is why I want to move on to Ted. And Ted, you can tell us, you must be talking to a lot of family offices, LPs. If they have to come into India now, what steps will they be taking? What are you hearing on the street, and what do you think they should do?
Sure. Well, I think the concern, it's all about sort of transparency and knowledge, to be honest. And actually, I slightly err on that broad brush of talking about LPs as one single class of investor, if you like. So LPs makes up lots of different things. So I suppose there'll be different approaches for all of them. But you're right. So family offices, pension funds, funds of funds, and I suppose the first is with their existing investments into funds that might be investing in India is actually understanding their own ownership structure, which is obviously easy for a certain type of LP, like a family office, etc. But something like a fund of funds suddenly becomes a lot more nuanced, and they'll need to potentially look at their own sort of KYC documents and the information they've received from their own investors to see if that's going to cause any issues going forwards. But I actually think one of the big concerns making a new investment into a fund that will be investing into India is actually about who the other LPs in that fund are, and whether that's going to cause any issues. So for a future investment or divestment, you as an LP, you might know you don't have any Chinese investors, and therefore the restrictions wouldn't necessarily bite because of your investment in the fund. But what you don't know, and you typically don't know in a private fund, private equity or a VC fund, is actually who the other LPs are. And so I can see actually as part of an investor's diligence on the fund and on the GP of a fund that's got a strategy that's investing in India is actually probing the GP a bit more as to what they'll do if this restriction bites because of Chinese money being in their fund, and wanting to get comfortable that some of the things that we talked about earlier, the ability to form parallel vehicles, etc., is in place. And worst case is actually LPs is actually becoming a bit nervous and not wanting necessarily to commit to an Indian fund until there's a lot more certainty around this.
Ted, this certainly came as a surprise to many of us. Do you think it's going to impact a lot of these? I mean, do the LPs now, will they go back and say, okay, let's have a look at clarifications coming out, and probably this will limit the amount of money coming in to this country for a while?
That's the risk, right? Like that I suppose, there's a scale, and to be honest, anywhere along that scale is slightly less money all the way up to significant amounts of less capital coming in. I suppose it will depend on the funding question. If it's an investor it's a global fund, and India's part of the strategy, maybe that's less of an issue versus than an Indian specific fund. But similarly, if it's an Indian specific fund, you'd feel an investor and the manager of the fund would be sort of all over this issue because it'd be so relevant to them. But that's the risk, right? Is actually LPs being put off in hopefully in the short term until there's a bit more clarity here, but being put off from investing in this location. Okay,
Ted, forgive my ignorance, but I want to ask you: have you seen similar reactions in other nations like the UK or in the USA or in Europe too? Have there been similar announcements against Chinese investments, or is this just an India one-off kind of a thing?
I certainly wouldn't say this is common. So no, I can't think of sort of equivalent restrictions, specific to China. Obviously the geography is relevant to India, and as we mentioned previously, COVID-19 as well. You do sometimes see certain types of restrictions, but often to be honest, it's less stark than this, and it's things like sort of certain funds in certain jurisdictions lose their tax benefits of their structuring if they invest in certain offshore jurisdictions and things like that. This maybe feels a starker restriction, if you like.
Wow, I'm glad you called it a starker restriction, and I love this panel for bringing out a lot of reality. Jitesh, I want to talk to you. Everybody's spoken about the challenges. You want to sum it up as a lawyer? What do you think about the way forward?
Sure, Vishal. I'd like to probably put it in about 5 to 6 or maybe 7 points. I think the first important thing is that this press note does not have a sunset clause, and that is extremely critical. And it also does not define what is an opportunistic takeover or acquisition, and it also does not differentiate between what is opportunistic and non-opportunistic takeover or acquisition. I mean, I think very quickly clarity should be provided by the government, and to differentiate between what is a strategic investment or a financial investment and a and an opportunistic bonding. I think one of the big challenges that investors and lawyers are finding these days is that we are trying to rely on a lot of the definitions that I stated above. However, none of these definitions are recognized either in the press note or in the NDI rules. Now, look, I also understand that the biggest challenge before the government is to define what is a beneficial owner. Now, look, I understand that as part of this discussion, we have some regulators, who are listening to us. So, I would probably recommend that, while it is very difficult for the government to define the term, considering the interpretational conundrum, it could probably be simpler for them to provide a sunset clause and define what is opportunistic and non-opportunistic takeover or acquisition. The government can then probably try and peg such investments to the definitions provided either under the Companies Act or the RBI's KYC norms or under the Money Laundering Act. Since the objective of the press note was to restrict opportunistic transactions, I think the best way would probably be to issue an FAQ. If the procedure to issue, because I understand that the procedure to issue a press note or a definition takes a little longer. So till such time, I'd clearly say that it will really lengthen the timelines for closure of transactions. And as investments, because investments will have to pass through this new investment control protocol. So over to you, Vishal.
That's the biggest challenge, perhaps. And listen now to the fun part. Gentlemen, you've been wonderful. Thank you for answering these questions on the press note. Now, let's move on to the fun part, which is the audience questions. I think the lawyers should take the first question. I'm an edtech startup. An individual says, I'm based in Bangalore. I've got a couple of investments from China. In fact, they own probably 40% of their company. In that case, what do I do now? Am I to, do I continue my operations, or is somebody going to come knocking at my door and asking questions as to what is the origin, where are these people domiciled, and all that?
Sure, I'll take that up, Vishal. Look, it doesn't affect investments which are already there till the extent there is no exit. So you could continue with your operations. I think the government approvals would be required if and only if your exit is to another Chinese investor or to an entity where the ultimate beneficial owner is a Chinese entity. So if you were to sell it to, if let's say the 40% stake, which is now held by your Chinese investor, is sold to, let's say, a UK company or a US company which does not have a Chinese investor or shareholder, you're good. There is absolutely no restrictions, and you do not require government approvals.
Ted, do you want to add something here on domicile and questions being asked? How does a startup handle this?
Yeah, looking at some of the questions, it slightly ties into, and I'm sort of coming at it from a fund structuring perspective rather than operating company perspective. And I'm assuming ultimately there will be an operating business in India in the sort of context of all of these questions. But I suppose you could apply or try to apply the same things that I talked about earlier. Effectively, what you're trying to do through structuring is separate the Chinese capital from the Indian investment. But remember that, which sounds simple, that's like half a sentence, but there's quite a lot of complication that comes with that. I suppose one thing to think about, again, moving to the fund context, is you don't actually want to make too big a separation within the same fund, because then if you start thinking and talking about fund performance, as an example, if you've got a large part of your portfolio in companies that a large number of your investors aren't actually invested in, are you actually operating two funds in reality rather than one? So it sort of sounds simple, but I think almost on a case-by-case basis, you need to look at the makeup of the LPs, the investment strategy and where you'll be investing, and how the two sort of marry up.
Okay. And guys, I don't know who's going to take this question. This is about, was this move made to actually get Indian investors to start investing in a lot of the companies rather than raise global capital? Uh, Please, who wants to take this? This is like a curveball at me or a bouncer, you know?
Anirudh, you probably the best place to do this.
I just knew it was coming to me. No, see, I think Indian investors were already participating, right? I don't think that the entire ecosystem was just working on foreign money. Indian investors, whether it was the listed companies, I think the top 100 listed companies in India already had allocations to participate in the listed ecosystem. I mean, using Oyo as an example, Oyo, as per his last funding round, is worth more than all of the listed hotel and restaurants companies in India. All their market cap combined is less than the valuation of Oyo. And this is a 26-year-old Ritesh Agarwal who started the company less than 8 to 10 years ago, right? So in 10 years, he's literally overtaken everybody else who's been building businesses for decades. So I think in that sense, Indian corporates, Indian families were already looking at saying, we can't miss out on the next wave of Indian startups. So that money was coming. And that's why, you saw a wave of exits also happening. I mean, we sold 2 companies to Geo platforms ourselves, right? And so I know that they were very aggressive, and they were investors that paid premiums to the last round valuations. So to that sense, I don't think this really was to excite Indian investors. I think it might have spooked them a little bit because unlike the listed markets, and whenever the FIIs sell, the LIC is buying, right? And vice versa. The DIIs always come in and fill in the gap. In India, you don't have anything like that, right? So if you stop the inflow of Chinese money, is DPIT or SIDBI or the government of India or the Ministry of Commerce, someone needs to step up and start pumping money in. Otherwise, you're going to see a collapse. And I don't think this really should have been the kind of playing the game of chicken, that if there's no investors from abroad, then will Indian investors step up? I hope it wasn't, and I don't think it's the right thing.
I think, Anirudh, if I can just add one point, the beauty of the Chinese investors is they've actually seen these sorts of models work at scale, something which even people from the UK or the US haven't sometimes. And so when the reason they're coming to India is because they've seen it work, and it allows them therefore to be a bit more aggressive. And if you stop that flow, I'm not sure you'll replace it with Indian investors or Indian corporates who haven't seen this work and so are a bit more hesitant.
In fact, to your point, and I think so one of my personal investments has Chinese money, and when the investor came in, I actually sat down with the founder to understand, how did this Chinese investor, what is the level of due diligence that they do, and they're at a different level, right? I don't think any Indian investor does the kind of DD that they get into, even while they're sitting abroad, right? They're checking code, they're reaching out to ex-employees on LinkedIn, and they're getting feedback on the founder. And it really took my own due diligence and my own investing style to another level to understand how the Chinese invest. So we can't deny the fact that these guys are far beyond, far ahead of us in this game, and leaving them out of the game will probably hurt us more than help us.
Okay, fair point, guys. And this is a question from Aditya Bhatia. He says, okay, what if I'm a company registered abroad? The parent company is abroad and they have a subsidiary here in India. Should they have to be worried about this press note? A lot of the SaaS companies follow that Delaware C Corp route. They are registered in the US and then they have a subsidiary in India. Do they have to worry about it?
I can pick up that.
Yes, please.
Yeah, I can pick up that, Vishal. So we are talking about a scenario where that holding company, which is in a jurisdiction which is not part of this land sharing or that, any of the specified countries. And that holding company has 100% subsidiary here in India, and that investments are happening at that holdco level. So in that case, the question here is whether it would attract the provisions of the Press Note 3. So here, what I have seen that most of these cases that the relationship between that holdco and the 100% subsidiaries here, or that subsidiary here, has already been established here, and there would not be any change in shareholding between these two entities whenever any further financing round happens at that overseas level. the relationship between India and that holdco would be on a cost plus model basis. That means that whatever the expenses incurred by the India company for the supporting the operations of the holding company would be paid by that holding company to India company based plus certain margins. In such cases here, so that whatever the investments they get outside India can be that bring it down to they can bring it down to India subsidiary without any changing the shareholding pattern of the company. So technically, if you go by that route, it would not come under the purview of that press note 3.
So if you're a SaaS company, guys, then don't have to worry. I love the gumption of our entrepreneurs. I see two sides of the coin here. There are questions, obvious questions saying, why do we need Chinese money? That's coming in. That's a funny question to ask. And the second one is, will my valuations be affected? Are valuations going to be affected because of this press note?
I think, Abhinav, this one's for you.
Look, I think so. There are many things which go into valuation, right? Essentially, it's about in the future, how will the company react? Part of it is the ability to raise more capital, right? And the ability to overcome any mortality risk. Right now, many of these companies have a mortality risk, and so if it has Chinese investors and you have a sense that they will not be able to follow their rights, it will have an impact on valuation, right? And worse still, it can really hurt the company and question its viability. See, again, I think we should not forget the broader context behind this press note, which is COVID-19, the fact that the economy is, has been decimated in a way, the demand patterns have changed. So all that uncertainty impacts valuation as well. So I would say yes, and one needs to accept that and move on.
Wow, that then there'll be. I hope the media isn't watching this because that's going to be the headline for tomorrow, right? Especially with right, Abhinav. So listen. So go on. I mean, anybody else wants to add on this topic of valuation before I move on to the next question? No. Okay. Let me move on to the next one. It's really interesting. Maybe Ted, you could take this. What if I've raised money from a European tax haven, and will I be scrutinized also?
Yeah, looking at the question, I guess it's the level of scrutiny that's going to be done, and slight query what's meant by European tax haven, but generally speaking, the level of scrutiny that's done on beneficial holders. And actually, I think one of the challenges here is often there is a threshold that's applied to the local regulatory regime in most European countries and globally. There's a threshold above which you need to collect sort of further materials, information, diligence materials, KYC materials about the investors. And the disconnect here is, I think, the fact that there doesn't yet appear to that threshold hasn't been clarified here. So I suppose the thing that could slip through the net is a small Chinese investor that's sitting below that threshold that's applied, under the regulations of a particular other jurisdiction. So yeah, and that said, I think a lot of, and I know I keep referring to the sort of in a fund context, but a lot of typical fund jurisdictions where people are setting up investment vehicles, actually the level of scrutiny that's now required by regulators is very high. One of the big trends in fundraising and the fund markets over the last 10 years in particular, post financial crisis, has been increased regulation, and sort of people complain about it, but I think it's now accepted as a fact of life, and actually there are obvious benefits to it as well. But like I say, I think the disconnect here to me seems the sort of the thresholds that often apply in those jurisdictions versus what we have here. We don't yet know what the threshold is. I think the question for me actually would be, it'd be interesting, and maybe Jidesh, your best position is actually to understand if we have any clarity as to the likely timeline around where that uncertainty might be addressed. Because if this is a short-term thing, we've been fairly negative on the situation, maybe, or I have it on this call. But if it's a short-term thing, maybe it's not as significant. But obviously, the longer that uncertainty sits there, I think I can see that being more problematic.
Go for it, Jitesh. That's a very valid question.
Absolutely, Ted. I agree with you. And due to the uncertainty by the government, it can clearly the situation is such that a lot of investments are dependent on identifying who is a beneficial owner, and also to clearly identify how many layers of investors. There is no clarity from the government today. So we're all so I think I'm in exactly the same position as you are, Ted, because I know I'm an Indian lawyer, and but the law which the government has passed by way of the press note or by way of including or notifying the NDI rules also is such that it's not very clear. So we are hoping some kind of clarification or FAQ would come out soon, which would probably bring greater clarity and ensure investments start happening at a greater level. And I think it's very important, considering what Abhinav said, that Chinese investments into India is extremely critical. And I know for a fact that there are many LPs, could be also companies across the world who would still have one or two Chinese investors, and such regulations could be extremely restrictive and should probably come out with clarification quicker.
Okay, there's a question from Hong Kong, guys. I don't know. I mean, maybe Jitesh, Ted, you could take it. Apparently, CAS, the handle CASM, is a fund manager from Hong Kong, and he wants to understand how does it have an impact on him, and what happens to his fund if they have invested in India at this point of time.
Sure, I can take that up. So if the investments have already happened, till the time the investments are existing, there is absolutely no problem. Again, I'd reiterate to the earlier question that I answered. So when the fund is exiting, if the fund exits to either another fund or a strategic investor, could be international, could be Indian, or could also be a financial investor, or could be a secondary sale, or could be a listing. If the investor, if the fund's investment is sold to a Chinese investor or to anybody who has a substantial or beneficial ownership of beneficial ownership in this of a Chinese company in this particular company which is acquiring, then you will have to go through the approval. There is no leeway available at this point of time. And I hope that once the government clarifies as to what is opportunistic and what is non-opportunistic, it could probably help determine the future way for the fund.
Okay. This is a question I want to ask. What is the role of the government here? What kind of measures should it take to encourage investments to come into India? Perhaps we are coming close to our closing hour at this point, or a minute at this point of time. Like Ted asked, right? This cannot be a prolonged kind of a situation. It's really going to hurt a lot of these companies, and I don't like entrepreneurs, being left in the lurch. What do you guys expect from the government? I mean, a suggestion from all of you would be wonderful. Please, who wants to go for it?
I can go first. I think the government needs to provide an alternative for this Chinese capital to flow back in. While I understand that they don't want it to be, random direct investments coming in from China, but how about allowing fund managers, right, in the PE or VC space, right, allowing them to get direct investments from Chinese investors, as long as it is not coming to a certain threshold, let's say it's 40% or 26%, whatever is comfortable. But that way, at least the money still keeps flowing, and it also will help with the growth of the Indian PE/VC ecosystem. But to blanket stop everything, I think that has caused more issues and created more problems than solved them, right? And because I think as long as it's not a position where 51% is owned by a Chinese investor, the Indian investor, the Indian fund manager still has a lot of latitude on how he wants to run the fund and the strategy. And the money would probably still stay in India. There'd be a carry portion staying here, and there would be no direct ownership per se. I think that's one thing that the government could look at and offer some relief, at least to fund managers that are still fundraising or about to start.
Vinod, Abhinav, Ted, Jitesh, you guys have suggestions?
Yeah, I would love to add a few points here. That one is that for the purpose of the beneficial ownership, that my request to the government is that keep the thresholds to that 25%. The reason is that anyway that RBI has taken that 25% in that various other regulations, and which has been approved by the various other regulators in the past. So that I understand that what is the concern of the government and where they're coming from in this case. So that if we have the clarity of that beneficial ownership, that 25%, it would give a lot of that clarity to the investors at the time of their investment. Number two, that I prefer that to exclude this. My request is to exclude that Hong Kong from this list. The reason is that Hong Kong is not anyway that part of it. It's not a country which we share that border. Number one. Number two, that government of India has anyway a separate tax treaty with Hong Kong. In addition to that, what they have it with that other countries and China's. And thirdly, that most importantly, that DPIIT that track that investments from Hong Kong and that China separately for the purpose of that FDI. Since the government has already recognized Hong Kong as a separate entity for the various other routes, and in fact, the WTO also that recognized that Hong Kong is a separate entity for the purpose of that customs territories. That so that if we can exclude that Hong Kong, because a lot of the fund managers are based out of that Hong Kong, because Hong Kong has got a very robust, that fund management, the laws that, so that fund managers prefer to be in the Hong Kong, and they have the pooling vehicles outside Mauritius, Hong Kong, which is in Mauritius or in Cayman Islands. That would give a lot of benefits, and that would help that people to that get more inflows into that. The third and last point, I prefer to have that more clarity how to approach this applications process, and what is the time frame to get this cleared. What are all the steps involved to get this clearance? Once we have clarity on these steps, I feel that we can just remove a lot of that gray areas in this.
Any more suggestions, guys? Ted, you were saying something when Vinod took over.
Yeah, I actually think just sort of taking a step back and thinking about what the purpose of this restriction is, I think my suggestion would be to define beneficial ownership as having a significant level of control, and actually thereby making funds not be captured by this. Because if it's passive Chinese capital sitting in a fund that's managed by someone in the UK or someone in the US that has control over the investment, that, thinking of the purpose of this restriction, that is not the Chinese capital having control over this investment. And so I think very simply and quickly, you'd allow the capital, but you wouldn't have the risk that presumably this restriction was put in place to take account of.
I hope Delhi is listening to this, and that's a very valid point. I think that's fair, right? Abhinav, would you agree with that?
No, I would absolutely agree. I think if we stick to the spirit of why this press note came, it's largely around preventing control or loss of control of systemically important companies. And I think that can be achieved in a simpler way without stymieing other investments. I would only therefore say, clarity and at speed. These are difficult times. So the quicker that clarity comes, the better it is for the ecosystem.
Okay, so Jitesh, you had something to say. You almost stopped yourself.
Yeah, I think the best way out of this situation is probably have a sunset clause, because we all know why this came. Probably restrict it to a couple of months, and just define what is an opportunistic acquisition. I think that would really rest a lot of the issues that have come about, and provide clarity to investors, and would really not stop the genuine strategic investments that really come into India from China.
Okay, there's a question. I think this is a Chinese question. I have a Chinese company in India. The person says, Will it affect Chinese companies in India? No problem. I'm drawing money from my Chinese parent company, but does it affect them? I don't think so. It should not. It won't. Is that an astounding no, Jidesh? What do you think?
No, it does, because a Chinese
It does?
company,
Wow.
a Chinese company incorporated in India is actually an Indian company. Any company which is incorporated under the laws of India is an Indian company, and it's a rather unfortunate situation that,
You've
so
just
they
given
would
us a news
also-
break, man. You've just given us a news break. The number one selling phones are Chinese companies in this country, man. So yeah, that's true. Okay, I'm going to get online, offline with you and talk more about that. But the audience, lovely questions. The panelists, great conversation. I wish I could met you in person and probably had a few beers or coffees after this. But times of COVID,
good
we
times.
cannot. Yeah, please stay safe. But I'll see you all soon. Thank you, Jidesh, for organizing such a wonderful panel, and thank you for making me moderator. Anirudh, thank you for inviting me too. You're wonderful. Abhinav, Vinod, Ted, I'll see you all soon. Thank you very
See you
much.
soon. Thanks, Vishal.
Thank
Thanks,
you.
Sudesh.
Thank you very much.
Okay,
guys.
bye. Bye,
Bye.
guys. Bye-bye.
Thanks, guys.
Bye-bye.